How does banking system liquidity impact economic stability? Imagine a busy marketplace where everyone depends on the flow of money to buy, sell, and grow. If the money stops flowing smoothly, the whole market can slow down or even stall. That's what happens in the banking system when liquidity changes. Liquidity means how easily banks can access cash or assets that can be quickly turned into cash. It's like having enough fuel in your car to keep moving without running out. When banks have enough liquid assets, they can handle daily needs like customer withdrawals, loan payments, and operational costs without trouble. This keeps the financial system running smoothly and helps businesses and people trust that they can access their money when needed. If banks don't have enough liquidity, they might struggle to meet these demands, which can cause panic among depositors. This loss of confidence can lead to bank runs, where many people try to withdraw their money at once, risking bank failures. In a capitalist economy, banks act as middlemen between savers and borrowers. They use liquidity to create credit, which fuels investment and spending. When banks lend money, they help businesses grow and people buy homes or start new ventures. This lending is essential for economic expansion. But if banks lend too much or don't manage liquidity well, it can cause problems. Too much liquidity can lead to risky lending, creating bubbles in real estate or stock markets. When these bubbles burst, they can trigger financial crises that ripple through the entire economy. Regulators set rules to keep banks safe, like requiring them to hold a certain amount of liquid assets. These rules help prevent bank failures during tough times. Central banks also play a key role by adjusting interest rates and reserve requirements to control liquidity. When they lower interest rates, borrowing becomes cheaper, increasing liquidity. When they raise rates, liquidity tightens, helping to control inflation. Having a stable banking system with proper liquidity levels helps keep the economy steady. It ensures that banks can support economic growth without risking collapse. When banks manage liquidity well, they can lend confidently, businesses can plan investments, and consumers feel secure. This balance is vital for long-term economic health and growth. In short, banking system liquidity influences economic stability by making sure banks can meet their obligations, support credit flow, and maintain trust. Proper management of liquidity helps prevent crises and keeps the economy moving forward smoothly.